Hey everyone, welcome back to Corporate Decoder. Today we are diving into some financial documents, and it might sound boring, but trust me, there are always some hidden gems or maybe hidden traps waiting to be uncovered. This time we're decoding FS Credit Real Estate Income Trust. Let's see if they're building a solid foundation or just stacking loans on shaky ground. FS Credit Real Estate Income Trust just filed a Form 8K, which is basically a quick update they give to the Securities and Exchange Commission about big news. The big news here is a new financial structure called a Collateralized Loan Obligation, or CLO. This CLO is a way for them to bundle up a bunch of loans and sell them off to investors. Think of it like slicing up a pizza into different size slices. Some are riskier and some are safer, and then selling each slice separately. This whole deal went down on February 19th, 2025. The company created a special part of their business to issue or put out this CLO. It's like creating a separate company just for this one deal. This special company, named FS Rialto 2025 FL10 Issuer LLC, is the one actually selling these bundled loans or notes. They created different levels or classes of these notes. There are 6 main classes they are selling to the public, called the Class A notes, Class AS notes, Class B notes, Class D notes, Class D notes, and Class E notes, and Class E notes, Class E notes, and Class E notes, and Class E notes, and Class E notes, and Class E notes. So overall, Class does, Class EC notes, Class E notes, and Class E notes. They also created 3 other classes of notes, but they are not selling these to the public. Everything about these notes is written down in a legal agreement called an indenture. Think of it as the rule book for this whole CLO game. This indenture involves the company, a trustee, which is like a referee, and a note administrator who keeps track of everything. The company itself is acting as the advancing agent, meaning they are putting up money when needed. They are also the collateral manager, meaning they are in charge of managing the loans that are bundled together. The different classes of notes have different amounts and different levels of risk. For example, the Class A notes make up a big chunk of the total, almost 57%. These are considered the safest and have top ratings from the rating agencies. The other classes are smaller and have lower ratings, meaning they are riskier. They also have different timelines for when they need to be paid back. The initial weighted average life of notes is how long it will likely take to pay off each class of notes if everything goes as planned. The fully extended weighted average life of notes is how long it would take if everything takes longer than expected. All the notes are set to fully mature or be paid off in August 2042 unless they get paid off earlier. To sell these notes, the company used a group of placement agents, kind of like salespeople for financial products. These include big names like Goldman Sachs and Barclays. It is important to know that the notes are limited recourse obligations. This means that if the CLO doesn't have enough money to pay back the investors can only go after the assets within the CLO itself. They cannot go after the company's other assets. The Class H notes are extra risky because they aren't even secured by any assets. These notes haven't been officially registered with the Securities and Exchange Commission, so they can only be sold under special rules. The money from selling these notes was used to buy a group of loans, pay off some old debts, and cover other costs. The company bought these loans from a seller, and they signed an agreement called the Collateral Interest Purchase Agreement. This agreement says that if something is wrong with any of the loans, the seller has to fix it, pay the CLO money, or buy the loan back. The notes are secured by a bunch of things, including the commercial mortgage loans, money in different accounts, and other investments. All of this is called the collateral, which is basically what the investors can take if the CLO doesn't pay up. The interest rate, which is the amount of money the note holders make from lending their money on these notes, is based on something called a benchmark. Initially, it's termed SOFR, which is a standard rate, but this could change in the future. The interest rates for the different classes vary. For example, the Class A notes have a rate based on the benchmark plus a certain percentage, and this percentage can increase over time. For example, it goes up in December of 2030. Interest payments can be delayed if there isn't enough money, but this only applies to the lower classes of notes, like the Class C, D, E, F, and G notes. This delayed interest gets added to the amount owed on those notes. The indenture allows the company to exchange some of the lower rated notes like the Class F notes and Class G notes for other types of notes with different characteristics. To protect the note holders, there are note protection tests. These tests measure the quality of the loans in the CLO. If the tests aren't passed, the company has to use money to pay off the higher rated notes until the tests are satisfied. One test is the minimum par value, which measures the overall value of the loans compared to the amount of notes outstanding. The other test is the minimum interest coverage, which measures whether the income from the loans is enough to cover the interest payments on the notes. The CLO includes a 24-month period where the company can buy more companion participation interests. Basically, it's a period for them to buy more loans. The company has hired Wells Fargo Bank to service or manage the loans. They also hired Rialto Capital Advisors to specially service the loans, which means they handle the difficult situations. These companies are paid fees for their services. Because of the way this CLO is set up, it is likely considered a taxable mortgage pool under tax law. This can create some complicated tax situations for the company and its investors. The company intends to pay any corporate tax owed on this income. For tax reasons, the company wants to make sure this CLO issuer stays as a qualified REIT subsidiary. If it doesn't, it could trigger problems with the indenture. But to do this, it must remain wholly owned at all times by FS Credit Real Estate Income Trust. This limits the company's ability to sell off these notes. So what does all this mean? FS Credit Real Estate Income Trust has created a complex financial structure to bundle and sell off a bunch of loans. This allows them to get cash up front, but it also comes with risks and responsibilities. On the positive side, this CLO deal allows FS Credit Real Estate Income Trust to free up capital and diversify their funding sources. The structure with different classes of notes allows them to attract a wider range of investors with different risk appetites. The note protection tests are a good thing because they provide some level of safety for the note holders. However, there are also some notable downsides. The CLO structure is complex and it can be difficult to understand all the moving parts. The company is exposed to risks if the loans in the CLO don't perform well. The tax implications of being a taxable mortgage pool could be complicated and costly, and the company has to be careful to maintain its status as a qualified REIT subsidiary. From a valuation perspective, it's difficult to give a precise target price without more information. However, based on similar REITs and CLO deals, a reasonable price range for FS Credit Real Estate Income Trust might be between $10 and $12 per share. This assumes that the company can successfully manage the risks associated with the CLO and continue to generate stable income from its real estate investments. Overall, my bias is slightly bearish to neutral. While the CLO deal has some potential benefits, the risks and complexities are significant. I'd like to see more evidence that the company can successfully navigate these challenges before becoming more bullish. Thanks for watching Corporate Decoder. If you found this breakdown helpful, be sure to subscribe for more clear explanations of complex corporate filings.